Good morning from London. I'm Anna Edwards alongside Guy Johnson and Tom Mackenzie. We're an hour away from the opening trade. Here's what you need to know. Bonds sell off, long-end Treasury and JGB yields continue to climb after Tuesday's slump in Eurozone and UK sovereign debt as deficit concerns mount. Donald Trump accuses Xi Jinping of conspiring against the US with Vladimir Putin and Kim Jong-un. The Chinese, Russian and North Korean leaders coming together to witness a show of Chinese military strength. Plus, Alphabet shares surge after hours as Google avoids being forced to sell off its web browser in the biggest US antitrust case in almost 3 decades.
So we watch for the tech read-through then after, of course, a slump in European shares yesterday, closing lower by around 1.5% on the Stoxx 600. Today, you're seeing a little bit of a reprieve, pointing higher now by 0.3% on the Stoxx 50 futures. We got Jolts Data, of course, out of the US later. Manufacturing was a little softer than expected. US futures pointing flat right now after softness as well, down about 0.7 yesterday. But maybe again, the tech story will prove a little bit of a lift for US markets as we head towards the open, of course, this Wednesday. The US 30-year in focus, given the continued sell-off in the bond markets at the long end, as we've been discussing, closing in on 5% for the 30-year. Yields up again 2 basis points in the session today. The pound in focus after that more than 1% drop yesterday. A little softer again in the session. We're seeing dollar strength today. The pound down 0.2 at 133. The countdown to the opening trade starts right now.
Wednesday morning, good morning. Normally this show is built around the idea that actually the story is 8 a.m. London time. That's when markets open. In reality, actually, with the bond market firmly in charge, the markets are already open. We're watching what is happening in the States. We're watching what is happening in Japan. We're going to get the European EGBs, European government bond markets, opening at 7:30. Gilts are going to open at 8. It is a packed agenda this morning. And the bond market is in charge. Yeah, absolutely. The bond market in focus. So what will the rising yields at the long end, what will that do to stocks? How will we watch that relationship over the days and weeks that come? But let's focus in on what we're seeing here and now. You mentioned this market never seems to sleep, and certainly the Japanese market is the focus of our attention right now, up by 7 basis points at the 30 and 40-year tenors over in Japan. We've seen the 20-year JGB hitting the highest since 1999. So that's the epicenter of the focus at this point. And our guest coming up in around 15 minutes' time thinks that Japan is worth a lot of our attention. But this is a global story. It has been over the last 24 hours at least. We've seen European government bond yields going higher. Italy was up by 6 basis points yesterday. France, UK, Spain up by 4 basis points. And the US 30-year testing 5%. So that's where we're focused this morning.
And the question that Guy posed yesterday was, at what level do these yields start to put pressure on the equity markets? And we saw that certainly reflected in the European session yesterday. Today, things are looking a little bit brighter. You saw the softness yesterday on the stateside trading session as well, down around 0.7 on the S&P 500. But this, when it comes to the long end of the bond market, this is a parade of the ugly. Where do you look? There's a number of factors. Of course, there's inflation, there's the fiscal concerns, there's Fed independence when it comes to the US. But where do you turn if you do have to have, and you're compelled to have, those long end bonds in your portfolio? Japan with its political crisis, France, political crisis, Spain can't get a budget through, the UK leading up to October. Where do you look for that sustained picture in terms of a government that has fiscal control? I'm looking at China. Interestingly, we return to geopolitics shortly, but the 10-year in China is currently yielding 1.7. You look at that and you compare that to what's happening in the UK, France, US, very different picture. But this is a parade of the ugly when it comes to long-term debt.
Yeah, post-COVID ugly.
Yeah, what's causing it, I think, is open for debate. Eric Lonergan's going to be joining us talking about the fact that he thinks that this is just a Japanese story. We'll come to that debate in just a moment. What are we getting? Where do we go from here? Is the signal, though, for higher yields? Does it continue along this trajectory that we're on currently? We talk about the 5% mark for the US. Are we heading there at the 30, or are we going to head there ultimately for the 10? What are the catalysts that we're going to see maybe to drive us higher from here? I think it's also really worth watching what is happening with the corporate bond market as well. Huge supply coming to market at the moment. Is that a signal the corporate treasurers are saying, we think yields are going sharply higher as well?
Yes, absolutely. And that is exactly one of the points being made on the Markets Live blog overnight, and also making the point that, yes, we've seen a lack of volatility, actually, in the Japanese bond market because the market seems to be convinced that yields are going higher. And there's an inflation story in Japan. Japan's the outlier. We've got, hiking interest rates is the story over in Japan. And we will return to that story about what is being driven globally by the Japanese push out of those ultra-low interest rates, which has been a multi-year story, but really seems to be gaining momentum right now.
Gilts obviously led the charge yesterday in terms of the sell-off, but it's worth noting, of course, that the 10-year was oversubscribed, massively oversubscribed with the issuance yesterday from the UK government. The demand was there, and yet it didn't cap, of course, the sell-off in yields. Because some investors telling Bloomberg, look, when you're getting close to kind of 6% on the 30-year in the UK, this was a 10-year auction yesterday, you know, that's hard to ignore if you're planning for that long term. You want that long-term exposure, locking in close to 6%. Again, the 10-year was substantially oversubscribed.
Yeah, so were Japanese debts, yes. The Japanese auction yesterday, do you remember that went well?
Yes.
Didn't it?
And Italy
then
with the
today
sevens.
doesn't go well. Yeah.
France tomorrow. I did bump into one investor yesterday who said, yeah, we're going to 6% in the UK, though. You get a 6%, you got a problem. There is this argument that this isn't a crisis, that 6%, is it going to be a crisis? Let's talk about what we've seen out in Beijing overnight. 80 years since the end of the Second World War. This is what this event is meant to mark, though you could argue maybe it's actually the end of the Sino-Japanese War, which also kind of was fairly significant in terms of Chinese politics at that point in time. Huge numbers of leaders there. Obviously, the big names that stands out, Kim, Putin were there. 26 countries were represented. It was impressive. The pictures are impressive. In Tiananmen Square, apparently you weren't allowed to cook breakfast if you were a resident near Tiananmen Square this morning because they were afraid of the smog. They were handing out eggs, apparently, so that you could make that happen. President Trump sees this as a conspiracy.
That chimes with my experience, by the way, the lockdown that you get in Beijing. I've been at one of these military parades, and you know you're ordered to pull in your laundry from your windows. That wasn't me, but some people do have laundry hanging. They have to pull that in. They have to clean up the city. So the amount of effort and security goes into this is significant. To your point, that we do not see pictures of Putin, Kim, and Xi together like that. I can't remember the last. We've never seen. This is the first time. It's remarkable. So it's a show of hardware, military hardware. It's a show of that partnership. And this is a reminder that these three powers particularly want to create a new, not just security architecture, but financial and economic architecture as well.
That's the real point. I think the big takeaway from the last few days has been this idea that not only do we have this kind of military story, but we have this economic architecture that has been created, driven by the Chinese. How effective that push will ultimately be remains to be seen, but it is on. And the chase is on. The whole de-dollarization story kind of fits and chimes with that narrative. And I think that's the interesting bit. The energy story yesterday that you were highlighting, all of this fitting together to create that narrative. That's maybe, if I was Trump, that would be the conspiracy that I would be looking at.
And President Trump, as you say, flagging that, well, he sees this as a conspiracy, saying that this is a conspiracy against the United States, and China turning a blind eye to some US LNG shipments as if to symbolically, turn their head towards Russia, as they are doing with that pipeline that we discussed yesterday.
Just before we talk about Google, I think this is excellent news for Europe, though, in a sort of tangential way. If you think about it, if China is going to get pipeline gas out of Russia, then China is not going to need the LNG that it currently buys on the open market, which Europe has to compete for. So in theory, LNG prices are going to go down, which should be good for the high price of energy that Europe is currently paying. So there could be a derivative that comes off this, which could be positive.
Because this potentially offsets about 40% of the LNG that China is currently getting, which puts that on the market and lowers prices for Europe. Interesting take in terms of what it could mean for bills, utilities, companies.
Talk about
Google. Look, I think the clear takeaway from this, let's just quickly and briefly remind viewers. A judge last year ruled that Google had been practicing monopolistic practices when it comes to its search business. And we were waiting for what the remedy would be, and that came through yesterday. And the most dramatic part of that prescription that the DOJ had pushed for has not come through. So the key takeaway is Alphabet does not need to spin off Chrome, and it can continue to pay Apple up to $20 billion a year, is what Apple has been receiving, for hosting some of these services on Apple hardware, notably, of course, the iPhone. So good news for Apple, and you saw that in after hours. Very good news for Alphabet. You saw that in after hours as well. Dan Ives from Wedbush, the analyst who watches these things very closely, says you can take off about $25 risk premium from the share price of Alphabet. And he expects, as a result of this is essentially a green light for Apple and Alphabet to work more closely going forward in terms of Gemini on Apple products, given Apple's challenges around
So when I read
AI.
this first thing this morning, my initial reaction was, actually, the ruling is bad news for Google in the long term. Short term, good news. bad news long term, because basically the judge is highlighting the fact that there are now competitors
Yeah.
in a way that there weren't in the form of Perplexity and ChatGPT and all these other products. So you think that's going to be bad news? It was interesting. I was reading, though, the Radio Free Mobile from Richard Windsor this morning. His note basically says, yeah, but Google can still do this much more cheaply than OpenAI can, and therefore actually has a cost competitive advantage when it comes to what it's doing with Gemini. And actually, therefore, this is really, really good news, to kind of double down on your point.
Yes, and there is no, there's been no limitation on their AI ambitions put in place by what is happening here. And the judge made the point, the fast-changing nature of this industry, the judge made the point that AI was not even mentioned. This has been a 5-year case. AI was not really mentioned at the beginning of this case. It took a few years for AI to start being mentioned as a reason why Google would continue to face, or increasingly face, competition in the future, and why the competitive landscape was shifting. But that is a fast-moving story. But interesting to draw a line under that particular dynamic. Let's talk about the guests that are coming up, Guy. And
you already mentioned some of them.
We have. They've got some great views to highlight.
Eric Lonergan's going to be joining us, Calibrate Partners, macro hedge fund. Look forward to that conversation. Evie Hambro is going to be here as well. BlackRock talking about gold. Maria Weitmana is going to be joining us from State Street. Does she still like tech? The answer is yes. We're going to find out why. George Saravelos, Deutsche Bank's FX head of global research, is going to be joining us as well. Talk about the dollar, talk about what's happening in the bond market. All of that is coming up.
We'll also have 2 high-level interviews with corporate leaders for you, the latest on their company's performance. Kathryn Mcleland will be with us, M&G's CFO, so an interesting conversation with that particular money manager. Their numbers out this morning. Watches of Switzerland putting out a trading statement. Brian Duffy, the CEO of that particular retailer, will be with us. They are saying that they don't see material tariff impact in the first half. Will that continue? Will that be the story of the full year? That will certainly be one of the questions we will get to.
On the agenda then, for your diaries today, 2:15 p.m, UK's BOE Governor, of course, Andrew Bailey. 2:15 p.m. UK time. Andrew Bailey is going to be appearing in Parliament, so let's see if he gets questioned about the sell-off that we've seen in the bond markets. Of course, front page news here in the UK on the back of that. 3 p.m. UK time, it is the data when it comes to some of the detail around the jobs market of the US, with the US job openings data, the Jolts data, that drops at 3 p.m. UK. We'll break that for you. And at 4 p.m. UK time, President Donald Trump will be welcoming Poland's president to the White House as well. Of course, a key player, Poland, in terms of supporting Ukraine. So we'll see what the conversation on defence and security is in terms of that relationship. And at 5:15 UK time, Prime Minister Keir Starmer meeting with his Spanish counterpart, Pedro Sanchez. 7 p.m. UK time, it is the US Federal Reserve Beige Book, as we see reporting that Scott Bessent is going to be starting those interviews this week.
Yeah. For the new Fed boss. 11 names. Some of them are going to be done over Zoom or by other video and conferencing facilities which may be available to the US government. We'll wait and see. Anyway, I think that's a really interesting process and may encourage those names on the list to sound even more dovish than they already are. What else do you need to know this Wednesday morning? Bloomberg has learned that Jane Street has made second quarter net trading revenues of $10.1 billion, beating all of the biggest banks to set a Wall Street record. Sources say the sales figure is more than double that from a year earlier and pushes Jane Street's first half totals to a record as well. Trading volumes have been elevated as investors have rushed to reposition portfolios, of course, around President Trump's tariffs and all the other macro stories that we've been watching. AI unicorn Anthropic has closed a $13 billion funding round, nearly tripling its valuation to $183 billion. Anthropic says it will use the funds to meet enterprise demand, expand globally, and advance AI safety research. And the US is pushing back against many of the creative accounting that European allies may choose to use to reach their new NATO spending targets. The disapproval is putting Italy particularly on the spot as the government weighs whether to count the construction of a $15.7 billion bridge that links the island of Sicily with the mainland as military expenditure. I guess you probably can drive a tank over it. The US ambassador to NATO, Matthew Whitaker, said he was watching the project in Italy, quote, very carefully.
We'll watch that one too. Coming up on the programme, we'll check on the shares of British aerospace and defence companies. Babcock in focus after a report that the UK is in advanced talks to build warships for Denmark and Sweden. This on the back of that military deal for Norway. Plus, gold hits another fresh high. As the Haven trade ramps up, we will get the views of BlackRock's Evie Hambro later this hour. Up next, it's all about bonds as the global sell-off continues. We'll dig into the story and preview the European bond market open. That'll be coming up in around about 15 minutes' time, of course. If you have questions, if you want to get involved in any of these conversations, we do like to hear from you. IB plus BBTV Go is the function on the Bloomberg terminal. This is Bloomberg. Welcome back. This is the opening trade. Bond markets firmly in focus. Let's get an update on what is on the mind of Bloomberg's Valerie Teitel as we continue to see that global bond rout. Val, plenty of supply to focus on.
Exactly. Plenty of supply. My favorite subject, bond issuance. Yesterday was a record amount of issuance across Europe for one day, reaching nearly 50 billion euros in nominal value. This includes the UK syndication, that 10-year syndication, and Italy's syndication as well. These big, juicy syndications, they did go off with decent demand, but the bad news behind that is that these governments had to pay cycle highs in yield in order to get this borrowing across the line. We have elevated yields across Europe, whether it's Germany, Italy, the UK, or France. The 10-year sector is hovering at or near cycle highs in yield. It's also tempting this global bond route further. We're seeing it in the Treasury market. We're seeing it in the JGB market as well. The 30-year Treasury coming very, very close to 5% in the overnight session, trading just a whisker away from 4.99, up 2 basis points on the session. The possible kicker for steeper curves here could be the Jolts data out from the U.S. later today ahead of the non-farm payroll point on Friday. But we also heard from the Wall Street Journal that Scott Bessent, the Treasury Secretary, is beginning the search for the next Fed chair. Those interviews beginning on Friday. Plenty of catalysts for steeper curves, Guy. I don't see any catalysts for flatter ones.
Not right now, no. Certainly seems to be the narrative. Is it about to change? Are we getting to the end of this narrative in the near term, though? That is a key question. Valerie, thank you very much indeed. Joining us for more on these markets, Eric Lonergan, even. I'll try and spit that out. Discretionary macro head at Calibrate Partners. Good morning.
Good morning. Very
nice
good to see you.
Are we nearly done? We were joking as we sat down.
Yeah.
When the traditional news starts covering the bond market, you know that probably we've reached an end to the near-term pain.
I think so. I think we're in the realms of a local high in yields. I'm not going to pinpoint it and say it's today, but it's music to my ears to hear somebody saying I can't find a single reason for these things to rally. Like that's exactly when. If one goes back to the depths of the equity market, say in April, nobody could find a reason. If you remember that weekend, I think it was of April 9, nobody could find a reason down the equity market, and we're 15% higher. I would have a reasonably high degree of confidence if you could fast forward 3 or 6 months. You'll probably make a lot of money in these bond markets.
A lot of money?
Yeah. Bear in mind, a 30-year yield, if you get a rally of 100 basis points, say, you're talking about, 20% capital return. So could you rally 25 basis points? You could rally 25 basis points in very, very little.
Who would be the buyer there? Who's buying? Who's the marginal buyer in Europe
but it's price itself. We know the way these things work. It's important to you've got to have a lot of clarity, and you've got to step back and try and think carefully about this. Who was buying? The question we should be asking ourselves is who was buying these bonds when they were yielding zero?
Yep.
Right. I didn't have any.
Yep.
The point is the yield to maturity is the yield to maturity. So take the 30-year gilt just because it's the highest level of yield. Actually, the UK isn't that interesting. We can talk about why. But if you take a 30-year gilt yielding where we have 5.6, 5.7, 5.8, that, if you think the Bank of England is going to deliver you 2% inflation over the medium term, that is an equity-style return now for owning a gilt. Now, we were told for most of the last 10 years that these were safety assets. What's really going on here is people were buying these hand over fist when yields were zero, when yields were 1. Yep. And they are sitting on huge capital losses.
Yep.
Right, they've experienced equity crash style returns. So there's a huge risk premium because we're pricing the past. If you go forward, if you're in your 30s, you can fund your pension fund, right? Think how difficult was it to fund a pension when the 30-year gilt was 1%, right? How much capital? Yeah. If the smart thing to do here is look at the income. And the reaction function is exactly what you want, which is people are going to stop issuing. Finally, people are going to stop doing QE. What's QT rather? QT, why on earth is the Bank of England doing QT? That's the question. That's with our money as the public, right?
Okay.
That's nuts. They were buying them at 0 during COVID. Yeah. They're selling them at 5.8. I don't know which book of asset allocation, right, they're using, but apparently it's okay if you call it QE and QT. I mean, the emperor has no clothes. I mean, there's the child at the back of the room who's going, sorry, what are you doing?
Yeah.
Right, that's nuts.
Is that you?
Okay, that is you. That is so many
Keep
questions.
Keep it simple, right?
So many questions.
Yeah.
We want to get to the bottom of a bit of the UK, because you say it's a bit of a sideshow, and that is interesting in itself. But I want to ask about Japan, because you say you have to understand Japan to understand what is happening here.
Absolutely.
Is this still part of this? You know, the Japanese were this outlier for a long time with these ultra-low interest rates when everybody else was hiking, and now they are hiking, and that's not... There has to be an impact of that.
Absolutely. Well, I think the lesson that you learn from looking... There's two economies I think are really interesting at the moment, which is Australia and Japan. For two reasons. Because if you looked at public sector debt to GDP, they're at opposite ends of the spectrum. Right? So Australia is currently fiscal perfection. Right? It's got a sub 2% budget deficit, 30% debt GDP ratio. And if you could choose to have a fiscal position, you would choose Australia.
Okay.
Now, actually, what's really interesting is you get up the chart of the 30-year yield in Australia. It looks like everybody else's 30-year.
It does, yeah.
So
there's a lot this morning. The 10's moved a lot this morning.
Exactly. So it's got nothing to do with fiscal policy, right? We know that. And so then we've got Japan is the other outlier. There's extreme level. So what has changed in Japan? Because Japan, we've known, has decades has been an outlier with the highest level of public sector debt, and yields have been the lowest. All of a sudden, things have changed. What's changed in Japan is inflation. Inflation is the critical variable, and it's changed uniquely in Japan. I mean, if you look at nominal GDP in Japan, did nothing for 20 years. In fact, there was effectively deflation, right? In the last, literally since 23, you have just had persistent increases in inflation. So if you look at the trend in Japan and inflation, it's completely different to anywhere else in the world, of the developed world. It keeps on going up. Now, you know, that is damaging. If you're the owner of a 30-year JGB yielding you 1% and there's 3% inflation, that is huge real losses. So you go 1%, 2%, 3%. And that has been a brutal bear market, which has terrified the rest of the world.
Right.
Because
and is it right that terror is exported? Is it right that it has such a global impact?
Well, is it right or is it not? I mean, you know, as somebody like me, this is the case for active management. This is, you know, why I'm a hedge fund manager, because these are grotesque mispricings. The skill for me is to stay in the game, right? Because I think we're kind of in a panic. Could we get a real panic move here? We could. We could get 25, 30 basis points. Of course you can. So there's two. You've either got to have time horizon and a resilience to volatility, or you've got to be very, very fleet of foot, okay? But we know that the prevailing narratives don't make sense, right? This is not about public sector debt levels. This is about investor behavior and investor psychology.
Well, that is part of the narrative clearly here in the UK, which you say is something of an irrelevance. So I want to fold two questions into one, which is, why is that the case, in your view, that the UK is an irrelevance? And what does that lead you to in terms of where the clear opportunities are right now?
Okay. Well, so the first thing to look at in the UK, because everybody keeps on going, we've got the highest level of 30-year yield in the world. I mean, first of all, what's curious is, why does anybody care about the 30-year yield in the UK? It doesn't determine anything, right? We don't have to issue any if we don't want to. Nobody in the UK's mortgages aren't set by the... But anyway, that's an aside. It's curious as to why are we obsessed with it, other than people saving for retirement who should be punching the air, right? Because they're just going, well, now I've got my income looked after. But if you actually look at the UK curve, right, take 10s, 30s, they're bang in the middle, right? The UK, if you look at net public sector debt in the UK compared to the rest of the G7, and include Australia, it's pretty much in the middle of the pack. It's not exceptional. The budget deficit is not exceptional. And the yield curve isn't exceptional. What's exceptional is the level of short rates. Right, the front end of the yield curve is higher because inflation's been higher. So what I would criticise our government for doing is, why hasn't the single focus of policy in the UK been, let's get inflation down? Okay. Right, because if inflation comes down, interest rates come down, and interest rates, by the way, are the biggest variable in the fiscal accounts. So what do? Every policy, the only policies that we're aware of, have actually raised inflation. That's been the act of self-harm. I mean, we would have been better in the UK without a government.
Eric, we could have kept this going for another 30 minutes at least. Eric Lonergan, fantastic insights. Thank you very much indeed. Discretionary macro ahead at Calibrate Partners. We're going to talk gold next with Every Hambro. Stay with us. This is Bloomberg.
30 minutes until the start of the opening trade. You're watching the opening trade, and this is the picture on European futures right now. CAC futures pointing higher this morning. FTSE futures not much happening there. But what a change from yesterday. Even any modest gains, a real change from yesterday. We saw the stock 600 down by 1.5% in session yesterday. Real estate stocks certainly did not like, Guy, what the bond markets were throwing at them, and all sectors in Europe actually were in negative territory. So, you know, modest gains they might be in the futures picture, but perhaps we'll take that.
Equity markets. Who cares? Let's talk about what's happening, the main action, the bond markets. This is the picture you have at the moment, which is interesting. You've got a bid back into France, you've got a bid back into Italy. Germany is not bid this morning, but not moving very much. You've got 10 years, I think, going out of the door a little bit later on in Germany today, but it's not a lot of them. The big story really is in France tomorrow, when we're going to see a huge auction going through a particularly long-dated bond. So keep an eye on what is happening there. But at the moment, things feel fairly quiet in the bond market. It's come after a session in Asia, which was actually a little bit more volatile, and it's going to be interesting to see actually, back to the equities, I joke, of course, to see whether actually a more stable picture in equities, in bonds, will produce a more stable picture for the equity market. But that's not the only market that is watching so carefully what is happening here with these bonds. Gold also front and centre, Tom Mackenzie.
Yeah, a little bit more stable in terms of the yellow metal and the pricing today. But here's the picture over 3 days, of course. That rally has come through. We've got through those record highs of 3,500 per troy ounce for gold. Over 3 days, then, gains of almost 2.5%. The catalyst, you can point to a number, of course, whether or not it is the expectations around Fed cuts, whether or not it is those ETF flows, the geopolitics, all of that seemingly putting a momentum into the yellow metal. To what extent can this continue, though, given that we have broken through those record highs? Let's get the view right now of Evie Hambro, Global Head of Thematic and Sector Investing at BlackRock. Evie, good morning. Thank you for joining us. With your prism focus, of course, on the producers of gold, do you think this momentum can continue? Are the catalysts there for further upside for gold, given the work that's been done year to date, up 30% or so?
Yeah, morning, guys. Morning. Thank you very much for having me on again. It's always exciting to be back, especially when we move to new highs. Yeah, as you say, the gold producers are really in a kind of perfect storm of positive trends right now. The cost inflation that they're seeing is very limited, and we've seen that in the latest set of results that came out over the last few weeks. And most of them are able to capture these higher prices and convert them into the expanded margins. That is what we've been looking for the last kind of 12 to 18 months now. So it was been really exciting to see that catch up in the equity trade relative to bullion, which, to be honest, up until this year has been lagging quite considerably. I think, and rightly so, because many investors were kind of fearful that companies would probably do the wrong thing with these expanded margins, or they wouldn't get the expansions that people were anticipating. So, you know, we've had a very good last few weeks. It's been really encouraging to see the gold equities move as they have done, and we're looking forward to consolidation from here into the balance of this year and into next year.
What does it mean for the mining space more broadly then, the gold mining space? Evie, does it fuel acquisitions, given the pricing, given the opportunities to expand footprints for some of these companies? Is that where this goes in the months and quarters ahead?
Yeah, Tom, it's a good question. I mean, I think we've seen quite a few trends recently in that regard. So, you know, the companies have been kind of dusting down the projects that have been on hold for many years. You know, with lower prices, sub-economic returns have meant that many of the projects have been shelved. These are now being reviewed. But what we're seeing, you know, most consistently across the board now is the companies looking to reward their investors. You know, it's been a long time in the wilderness for many gold equity shareholders. You know, they haven't had the dividend growth that we've seen in many other sectors, and the companies have been, you know, saddled with large amounts of debt and relatively low margins. That debt is now kind of mostly paid off, and the cash is coming through. It's being returned in dividends, but we're also seeing this rather surprising trend of share buybacks across the space. Now, I can understand the maths and methodology and thinking here, but it's always an alarm sign to us when a sector looks to, you know, redeploy its cash gains back into share prices. And, you know, we've got to remember that many gold share prices are up 100% year to date. Doesn't mean there isn't value in the shares, but is it really so wise to be buying back shares right now after such big gains, or maybe to have some cash on the balance sheet, or even just to pay it back to shareholders in higher dividend yields? I think that's what most people would prefer.
Evie, good morning. When you think about the underlying commodity, we think about gold and the strong run-up in prices that we've seen. How much do you attribute that to the drama that's been unfolding in alternative havens such as bond markets? Is that a link that's very present, and therefore is gold vulnerable if we start to see any change there?
Good morning, Anna. I think what we've seen driving gold over the last many years now has been a kind of gradual recognition across an increasing investor base that paper currencies are losing their purchasing power in a significant way. And when you extend that through into the bond markets, people are saying, well, do I really need to buy into government bonds at these relatively low yields, given the high rate of loss of purchasing power? And I think that's now starting to come through. When you add to that the expansion of government balance sheets and the ever greater need to finance activities by governments, as we're seeing in the UK here, with large amounts of spending not covered by tax revenues, there are only a few levers that they can pull. And I think that that is a realization across an investor base that fundamental physical assets are going to preserve purchasing power better through time. And people have been turning to gold. I mean, it's been with us for thousands of years. It was forgotten about towards the end of the 1990s and early 2000s. But now when you look across many multi-asset portfolios, there is a tactical allocation to gold. And that's done many investors incredibly well over the last few years. And it's pleasing to us to see this coming through. We're also seeing it in central banks. Central banks are looking to build gold reserves out of their kind of asset bases, moving away from the dollar. And that's been a significant trend over the last few years. So I think as long as these trends continue, then we're going to have these tailwinds for the gold price, and that will flow through into the equities.
And Evie, how do the various precious metals stack up against each other right now? Silver, we've talked about just the past week about the industrial applications, of course, and that's another dimension that perhaps gold doesn't have quite so much. So how do they stack up against each other in your view?
Yeah, it's difficult to compare them because, as you say, they're all very different. Gold has been a monetary asset for thousands of years. Silver was and has become much more of an industrial asset. And then you've got the platinum group metals that, again, much more industrial even than silver. So when you look at them, they have different supply and demand characteristics, and each of those has an impact on pricing. But what we are seeing is this kind of general move upwards. We saw the platinum associated metals move up during the summer and just before, and it's really exciting to see silver get some momentum behind it in the last few weeks. This breakout above 40 it brings that magic number of 50 back into the frame that people have been talking about for a very long time. So we're quite excited, and across our funds, the Gold and General Fund in the UK and our international gold funds, we've got a large exposure to silver within that. So the last few weeks have actually been pretty good for our investors.
Evie, good morning, it's Guy. Why are the miners not listening to you when you tell them to not do buybacks?
Yeah, I'm not saying that they shouldn't do buybacks. I'm just saying that when you think about a buyback, it's part of an overall capital allocation plan. And I think what we've seen is in the last probably 9 months, maybe 12 months, gold equities have been, very cheap 12 months ago, incredibly cheap. And then we've seen this massive margin expansion, and it took quite a long time for the equity share prices to gather momentum and really move. And they have done, especially over the last 6 months. And these buybacks are continuing. And I think that, when you look at other companies, they set out a framework where they think there is fundamental value in their businesses, and then they balance buybacks and dividends. And I think when you had such a large share price move, to continue to be buying in the market rather than returning cash to shareholders, maybe you just need to pause. We think there's a lot of value in the gold equities still, but what we prefer to see is the dividends catch up with the share prices. They've been somewhat left behind. We had good dividend yields last year. When you have a 100% share price move, unless the dividend goes up 100%, then your yields are going to compress. And so I think we need to see those yields move up to kind of 3-5% again before the company should look to be buying back shares.
What is the case for owning gold equities at the moment? If I'm an income investor, are these good income investments because you think the dividends ultimately will become to the fore, and actually that's where we'll see the case. If you're reinvesting dividends, where would you reinvest them? Would it be back into the space, or would you think the money leaves the space? Is this money that's going to exit? I'm just kind of wondering what the investment, the type of investor you think a gold miner should attract at the moment.
Yeah, again, I mean, we're seeing actually really good flows into our funds at the moment, which is deeply encouraging. So clearly the market out there wants exposure. So I think gold equities have delivered what the kind of promise that the management teams have been doing and telling people. So that's the kind of first tick in the box. The second tick is we're seeing significant margin expansion. When you look at the gold price today, it looks fantastic. $3,500 an ounce. Go into the forward market. Roll that out a few years and you see prices way above this level because of where the compounding rate takes you. Then you look at the analyst expectations and you see gold prices returning to, on average, between 22 and 2,400 over the next few years. That's a massive arbitrage in the market. If the sell side is wrong and we see a gold price above $3,000 an ounce or even spot prices, then there is an enormous amount of value in these equities. We're talking many times their current share prices. But we need to see the companies kind of hold on to that value, maintain the margins, and deliver those back to the investors. And I think when you have that happening, you will then bring the investor base with you. So the investment case is clearly the massive gap between the forward market gold prices and where the sell side expectations are. And we're talking multiples of today's share prices right now.
Great to catch up, Evie. Always a pleasure. Thank you very much indeed for your time this morning. Evie Hambro, Global Head of Thematic and Sector Investing, joining us from BlackRock. Thank you. Coming up, we're going to talk to the M&G CFO. The numbers have just dropped onto the screen. They want a big Dutch mandate. That's helping out the numbers. We'll talk about what is happening with Costa as well. We've also got more coming up when it comes to the corporate side as well. We're going to be watching out for what is happening on the Watches of Switzerland front as well. We'll do that next. This is Bloomberg.
Welcome back. This is the opening trade. It is Wednesday, the 3rd of September. Now, M&G has reported adjusted operating profit for the first half this morning, perhaps missing some of the analyst estimates, but a confident outlook and net inflows part of the story. Let's talk to Kathryn Mcleland, Chief Financial Officer at M&G. Kathryn, thank you so much for joining us. So let's talk about those inflows, because some of that coming from your efforts to get more business outside the UK. What's the big picture story then about that, about business coming from outside the UK? How big can that get?
Yeah, we were truly delighted with the record inflows we saw. So since listing, we saw 2.6 billion of inflows into our asset manager. And it really is down to the strategy we've had of diversifying the business. So one of the key stats we put out this morning is 58% of our third-party money, so that's away from our strong internal insurer, is now outside of the UK. And as we've seen, there's been a renewed interest in Europe and in active asset management. And so actually one of the big wins we had in the first half, which is so pleasing, is in the equities business. And we've got some real encouraging signs of that will continue, also in fixed income. So, yeah, I'd say the asset manager delivered 14% increase in fee-related earnings, which is great. And the flow momentum is there.
OK, we've been talking a lot this week, last week, about, in fact, for the past few months, about tensions in bond markets, some areas of volatility, sell-offs in bond markets, yields going higher, steeper curves. Some of that's in the UK, some of that's a global story. I wonder what impact that has on your business.
So the benefits of having such a diversified business model with a very strong insurer and a strong asset manager is actually we're resilient through all interest rate cycles. So typically when you see higher rates, it's actually strong for insurers' solvency ratio. So it benefits insurers. It also helps the profit trajectory in insurers. And in asset management, I think people at the moment do want to look to strong, active asset managers. We've had a very strong historical presence in credit and fixed income. There may be some impacts on AUM, but I'd say the benefits for us is that we actually do well throughout the interest rate cycle. And it's great that this diversification, back to your first question, is only increasing as the business grows outside of the UK.
Morning, Kathryn. Cost income down, moving in the right direction. kind of been from the high 70s, we're now into the mid 70s. What was it, 75 this time? You're targeting 70.
That's right.
How long does it take to get to 70?
So we started at 79, and
Yep.
Andrea and I have said that we want to get the cost-income ratio down every year.
Right.
Very importantly, the whole simplification and savings journey that we're on across the group is all about investing to grow. So the strong performance that we've had in asset management in the first half is also down to the investments we've been making in the business. So it's not just about shrinking. We are investing in our distribution teams to build out the franchise. So we've done 2 percentage point reductions on the year, 1 percentage point down versus year end, and we want to see that positive jaws continue. And given the momentum we've seen in terms of flows, we are confident that we'll continue to bring the ratio down to a 70% target.
Would it be easier if we saw some consolidation? Is that the way to take costs out of these businesses?
So there has been consolidation in parts of the industry. I think it's really encouraging that we're seeing interest again in active asset management. We have the real benefits in our business model of having this insurance balance sheet, which is doing well also. We've seen inflows coming through in PruFund. So we are absolutely successfully able to take up costs.
Yep.
And you've seen that we've also been
You can get
able
to 70 on your own.
Absolutely.
Can you get there faster with consolidation?
We have no intentions of looking at consolidation. The important thing for us is we have actually bought some businesses to build out our private markets capabilities, which is now at 77 billion. We bought a real estate value-add company in France. We bought a direct lender, private credit. I'm sure you talk about a lot, is also growing well. So we are building the business, becoming simpler, delivering better solutions for clients very successfully.
What happens to those asset managers, given the cost pressures, that don't consolidate?
So it's really interesting looking at the dynamics in the market. As I'm sure you've talked about all the passive inflows, and we are a strong active asset manager, and it's really critical that we deliver operating leverage in the business. And that's what we've been focused on since we launched the 200 million group-wide simplification program. We've upped that target twice, and we are on track to beat the new target of 230 million. So I do think being very clear on how you drive operating leverage in the business. But what's critical is you can't just cut costs to deliver profits. You absolutely have to grow in a very disciplined way to drive the top line.
We've seen the entrance into the UK of Apollo and Brookfield in terms of the risk transfer, part of the insurance market. What does that signal to you?
Well, you could say it signals that people do like our business model of insurance balance sheets, strong private markets capabilities, strong asset management. And we have re-entered the BPA market. We were in the market before. We re-entered in 2023. We want to do 3 to 4 billion of volumes in 2027. We're on track. So, yes, other people...
Does their entry make that more difficult?
So the market was already quite competitive. What's really important for us is we know where we want to play in the market, and we're very selective. So we've delivered double-digit IRRs on the 300 million of BPAs we've written. We're only aiming to get to 3 to 4 billion in 2027. And our private markets franchise is also helping us choose the sorts of deals that we want. And really importantly, for the pension schemes in this more volatile rate environment, often want a range of solutions. And we've been quite innovative, launching the value share BPA last year. So we have no concerns at all of doing the right trades at the right hurdle rates and hitting our volume targets.
OK, you mentioned the UK budget that is coming up, just in passing there, Kathryn. And does the financial services sector have something that it's looking for or not looking for from the government?
I think financial services companies and probably broader companies would just like to see clarity and stability. I think that's what's really key at the moment. Obviously, fiscal discipline also is important for the bond market. So we have been very engaged with the government around their growth agenda. We've signed up to the Mansion House Accord. We're on the British Infrastructure Task Force. So really is about delivering clarity and stability and having the right policies and actions to support growth in the UK.
Kathryn, thank you very much. Thanks for your time. Kathryn Mcleland, Chief Financial Officer of M&G. Their numbers out this morning. Let's get a look at some of the other stocks that could be on the move. Chloe Melly has a rundown. Chloe.
Good morning, Anna. Let's start by keeping an eye on UK defence firm Babcock this morning. The UK is reportedly in advanced talks to build warships for Denmark and Sweden, and those warships would be built by Babcock. This follows the news about the Norway-UK deal that would benefit BAE Systems. So quite a good week for those UK defence names, and we could see here for Babcock an extension of that quite impressive rally that we've seen over the last few months. And analysts generally are quite keen on that stock. We see quite a good ratio of buys to sells. We have about 0 sells on the stock, as we can see here, and 9 buys and only 2 holds. So definitely a stock to keep an eye on, especially given this kind of latest potential boost. Moving on to the world of sneakers. So we have got 2 new ratings for Puma and Adidas. Puma was downgraded by JP Morgan and Adidas was upgraded by Jefferies. Analysts are saying that Adidas is pretty well run, while Puma is facing quite a lot of intense competition. So we could see this outperformance by Adidas compared to Puma potentially continue, potentially widening that gap. And of course, Puma's new CEO, who just joined this summer, seems to have quite a lot of work to do to kind of get back on track and get back into analysts' good graces. And finally, let's end with the energy sector, where we've got a new note out on this sector in general by Morgan Stanley. So BP got upgraded, Equinor got downgraded, and then Shell is a top pick. So we could see some activity across those 3 names this morning. As we can see, there's already a lot of weakness in Equinor that could potentially continue. And analysts are saying that the outlook really depends on the trajectory of commodity prices, with oil and gas production expected to continue to rise. So let's have a look at that sector this morning as well.
Chloe, thank you. Our equities reporter, Chloe Melly, with the details of what we could be watching. And I suppose big picture, we're still wondering what impact higher bond yields are going to have on equity markets. That's not today's story, maybe, but it is a longer-term story that stretches out across this market in front of us.
At the moment, the bond market is actually fairly flat. France seeing nothing, so we are flat there. We dropped initially, come back up, so we're standing pat on the OAT market this morning. BTPs are lower in terms of the yield. Germany's a little bit lower as well. So is that a positive feed through into the European equity markets?
OK, futures currently pointing to gains, 0.5% as we click down, of course. 5 minutes away from the opening trade. Futures pointing in positive territory after losses yesterday. Stay with us. This is Bloomberg.
Wednesday morning, good morning. So equities are about to open, the gilt market's about to open. It's all about to happen. At the moment, the bond market looks OK with what is happening. Bit of stability there. Yesterday, obviously, the equity trade was dominated by what we saw in the bond market. A sell-off in Europe towards the close kind of picked up the pace as we headed towards the end of the day. Then a rally over in the United States. And that's what we are factoring in to Tom's board first thing this morning, with the exception, it seems, Tom, of the FTSE 100.
Yeah, the stability in the bond markets giving something of a reprieve, as you say, to the equity markets. The grip around the neck of stocks currently being eased. European futures pointing to gains then, the 0.5%. So making up for some, but certainly not all of the losses that came through yesterday, with, of course, European stocks ending lower by around 1.5%. To your point, Guy, the FTSE 100 is currently the outlier, pointing a little softer by 6 points. The DAX futures, though, pointed at a decent session, up 97 points, 0.4% is the signal. Guy.
I'll pick up, Tom. Yeah, it looks as if, all sectors were negative yesterday. Might we see something a little different in today's session? Let's go into some of the stock specifics and find out where we might go on those. Chloe was flagging Babcock. The FT has this report that the UK is in advanced talks to build warships for Denmark and for Sweden. So once again, we watch the defence sector. We're also watching Puma in the sportswear space. JP Morgan cutting its recommendation on Puma. That implies a 23% decrease from the last price. That's the downside there, according to their new price target. So we'll certainly watch that one. And watchers of Switzerland saying that they are on track after a good first half of the year. They've got a trading update out today, and they say they don't see material tariff impact. So we will certainly talk about that when we speak to the management of that business a little bit later on, Guy.
So the Chancellor, this checker, is currently tuning in, trying to figure out what's going to happen with the gilt market this morning. Chancellor, we may have some more positive news this morning if you are watching in terms of what we are seeing in the gilt market. It's about to open. We'll watch that carefully. Equity market markets also opening as well. Let's give you some numbers there. The FTSE 100 expected to be something of a laggard today. There's some interesting stock stories within it. We'll keep an eye on that very firmly. But at the moment, the FTSE is going nowhere in a hurry. In fact, slightly more positive in terms of the bid that we are getting in that market than maybe we anticipated, judging by the futures position. So we're up by around 0.2%, pretty much in line with what we're seeing in the SOX 600. But we wait, obviously, these other markets to open. We'll see what's happening there. The IBEX pretty much in line with the FTSE 100. Similar numbers being posted there. But there you go. The CAC 40 is out of the gate. The French market is up by 0.6% this morning. We'll come back to that market and talk more about what is happening in France a little bit later. We've got the DAX and the SMI still to open. So as we await what is happening in Germany and in Switzerland, I will hand it over to Tom to get a sector story. What are we seeing?
Top of the list in terms of the gains coming through, technology up 1%, and you can tie that probably to what's happening in terms of the ruling around Alphabet, the parent company, of course, of Google, seen as favourable, not just to Alphabet, but also to Apple as well. And after hours, both of those stocks were up on the back of that judge ruling that Alphabet does not need to spin off Chrome and that it can continue its payments to Apple. So tech up as a sector, 1.2%. Industrial goods also performing relatively well. 9 cents. Two sectors in negative territory so far in the session. Insurance a little softer by 5 tenths. Food and beverage also a little weaker by 0.1%. But other than those two sectors, every other sector in positive territory right now. Three sectors right now in negative territory, including utilities.
Yes. So we watch what's going on in equity markets, and things look much more positive than yesterday. Guy, you were talking about the bond markets, and maybe we have some better news. Well, we do, in the sense that the yield jump in gilts is not as big as it was yesterday, but it's standing out as moving in the opposite direction from the rest of Europe, which is not great news for the Chancellor. So I can see that the biggest gain is 2 basis points at the 7-year. So we're not talking about huge moves. We won't make too much of it, but it is moving in the opposite direction from the rest of Europe, which probably will not be what those who are mindful of the fiscal challenges are wanting to see right now.
Sorry, Chancellor. Not exactly the news that we were maybe anticipating, judging by what we were seeing in the rest of the market. In terms of the overall equity picture, therefore, I think we wait and we watch and see how developments progress from here. But it does seem as if tech is actually the positive theme that is coming through this morning, which is in some ways good news. I'm going to watch out and see what happens in the chemical sector as well. There's been some fairly disappointing data on the chemicals front out of Germany, which I think is interesting because we're about to get final readings on the PMI a little bit later, so we'll watch for that as well. But yeah, I think a calmer market this morning.
And some of the chip makers, to your point, it's the chip makers that are leading gains so far, with the likes of ASML up 2.4%, ST Micro over in Paris gaining 2.3%, ASM, BE Semiconductor all posting decent gains of around 2 to 2.5%. So that lift coming through for some of the hardware and chip making businesses, of course, located throughout Europe.
OK, let's bring in our next voice to the conversation. Maria Weitmeier joins us, equity research head at State Street Global Markets, a regular on the show, and welcome to the programme, Maria, once again. So we know that you like tech stocks. You've often told us you like tech stocks, and you know, AI stocks over the medium term have done really, really well, of course, and tech stocks in the mix there as well, more widely. Let's see what's on your mind, though, with that in focus right now. We looked yesterday, the NDX testing is 50-day moving average for the first time since April. It ended up closing above it, but testing it. And I wonder if you're seeing any reason for caution when it comes to tech.
Well, I mean, thanks for having me on the program. And I mean, and absolutely, you're absolutely right. We love tech stocks for a long time. We still like them. I think for us, the main thing to thinking about this tech trade is where is the alternative? And okay, we have, I mean, every day there is risk on, risk off, there is kind of slew of news, and tech is the biggest sector, usually have disproportional moves. But in terms of moving out of tech, rotating out of tech, you need to find a place where to go. And for that, you need to have some place where have strong earnings, strong outlook, strong, stable margins and revenues and pipelines. And so far, we don't have any. So it kind of still remains a default trade for us.
OK, so whenever we see days where tech drops, Maria, these are still buying opportunities, are they, for you, even at these valuations?
Yeah, absolutely. Absolutely.
And where else are you looking then? If there's a close run second, I appreciate your argument is you just don't see anything else around the world. There is no alternative to US tech. But what else catches your eye? What are the other themes that you're watching at this point? What's your favourite?
I mean, you're right. It's very hard to find the kind of close alternative. I mean, European small caps look quite interesting to us. So that's a sector that quite domestic, very kind of somewhat insulated from this huge trade uncertainties and big like geopolitical headwinds. They benefited. Those companies are kind of fairly kind of well capitalized, fairly strong, have access to financing. ECB cut interest rates, so that's potentially kind of small insulated area where we see quite a kind of strong potential. So underlying earnings story is robust, so we kind of comfortable thinking about that.
Maria, what would be the, I mean, do we extrapolate, for your focus on the earnings story and you dismissing the valuation stretch for tech, what would be do we extrapolate from that then that if the earnings story starts to erode for tech, that's when you would rotate out, or is there another catalyst that you would be looking at to kind of make that call?
Yeah, no, you're absolutely right. So valuations, I mean, of course, they're stretched, and we can throw in that investors are really positioned in tech, so it's really concentrated sector. So lots of risks there, and what will get us out is other place where you can kind of find strong earnings. So it's like a gap between tech, which is still kind of very strong earnings expectation, and the rest of the market. I mean, like say Q2 earnings, tech what grew like close to 25%, and rest of the market was 6-7. So the gap is quite large. So when we begin to see this gap turning around, like narrowing, then we potentially get out of it. And I think Q1 was kind of that story when expectations in U.S. tech were coming down, and other markets look potentially interesting. We had rotation into Europe and emerging markets, and and that kind of didn't realize. Since then, we saw downgrades in Europe, upgrades in U.S. tech. So we went back to that trade. But that's the sort of dynamic that can potentially kind of reverse the market.
Okay, Maria, stay away from European stocks. Just how do you make that call in light of 2% interest rates from the ECB, China that is looking to stimulate, and you flagged that as maybe a reason for looking at Chinese stocks, and that then leaks over to Europe, the stimulus that's coming through from Germany, and the fact that on a relative basis valuations are looking pretty cheap. I mean, you want to steer clear of European stocks?
Oh yeah, no, absolutely, and I think that's exactly the same argument as earnings story. So we started the year with expecting European earnings to be 8-9%, and now it's -2%. So earnings story is really not happening, and France is kind of prime example of that, is -10 earnings expectations now for the whole year. So that's where the challenge is. And yes, interest rates have come. ECB has cut interest rates, but I mean we know Europe is kind of very export-oriented manufacturing economy, so kind of sluggish global growth is a problem. U.S. tariffs is a problem. Stronger currency is a problem, and that's all feeding into kind of lack of investor demand. I think that's a problem. I mean, the other interesting factoid about Europe is that if you look at sector valuations, like relative to its own history, investors where we see cheaper sectors like consumer, like materials, like healthcare, that's where we see the biggest earnings downgrades. So cheaper part of Europe are really struggling, and then you have like financials, industrials that have some upgrades and look quite interesting, but they're already quite expensive relative to their history. They're already quite crowded, so investors went into there. So what's next? You need to see those laggards beginning to perform, and that's really not what's happening right now. That's where we see the biggest downgrade still.
Maria, how confident are you that you will know where the top is in tech?
Time will tell. But I think what's interesting about tech is investor positions are really extended. Valuation is very extended. So in a way, the top would be not like a 2-day sell-off and you're on holiday and you missed it. It will probably be quite a protracted trade, and we'll see like the big investor rotation. So I don't think you really need to jump in front of this train. And we see, in addition to kind of left tail risk, we have right tail risk. So kind of not being in tech trade is also quite painful for investors. So we think it's too early to do.
I read a lot about .com valuations, and you just highlighted the valuation story that is in tech right now. Is that useful? Do you ignore that? Do you take that on board? What do you think about that?
I mean, you definitely take it on board, but I think, like the important point to stress about .com valuation, yes, numbers are similar, but earnings profile is profoundly different. We don't have like market is not really putting like high prices on .coms. Market is putting high price on very, very strong earnings. I mean, you can probably argue they are kind of enormous barriers to entry, often, kind of oligopolistic structures that's very difficult to break with market forces, and it's kind of regulations that will stop it. And we see the kind of the path of latest regulation. I'll argue that, regulatory risk is much lower now than it used to be. So again, and we see the breakdown of those kind of huge companies much more difficult. That's very different from .com situation where we have anyone who has .com as a company name can kind of demand high valuation. Now it's very strong earnings that give you strong valuation.
Mary, are you seeing strong earnings in China? You're closing your short position on Chinese stocks.
Yeah, China is interesting. So for many, many years, it was a market where corporate earnings were quite sluggish and like broadly, and it was a difficult trade for investors to get in because regulatory risks were enormous. So if we talk about kind of regulatory regime and tax, that's paying risk. In China, that's 20-fold, right? So it's very difficult for foreigners to read. They stayed out of the market, and now we see that kind of Chinese authorities and kind of tech champions, they have the kind of interest aligned, and those companies are kind of, there is lots of subsidies going in, there is lots of attention coming to them. So that's
Maria, does the Chinese story, though, challenge the US story? Can China commoditize the AI story? Can it deliver chips that allow it to undermine what NVIDIA's doing? Still maybe use the NVIDIA software stack, but build the chips to undermine the case there. If China gets going on AI...
Yeah, no, I don't think that. I think the Chinese tech companies can do really, really well in China. I think it would be really difficult for them to compete globally and undermine NVIDIA. And the reason being that there is still, the tech, the chip technology, kind of hardware technology, China operates on kind of last generation chips, right? We're talking about at best 7 nanometers silicon, other than 4, and they try to develop their own, but it will take years, decades maybe, and by then the Western technology will move on. So I think Chinese tech will do really, really well in China. I think it would be really difficult for those companies to compete globally.
Maria, always a pleasure. Thank you very much indeed. Maria Weidmana, equity strategist, head at State Street Global Markets. Gilt yields are still worth paying attention to. They are still higher, and it's interesting actually the 30-year tenor around Europe is still actually fairly interesting. So pay attention to what is happening there. How does that rip through into what is happening in the equity markets? Actually generally a bid across most equities today. Nestle's still a little bit softer, Novo's a little bit softer, but defence names are up and tech names are definitely up. Let's get some more details. Chloe Melly's here with the details.
Okay, let's start with watches of Switzerland. We've got quite a positive movement this morning. The shares are up 6.7%. Watches of Switzerland said that it was on track for a really good 2026, and it also said, crucially, that it does not expect a material impact from US tariffs. So that is driving the stock this morning. Moving on to the chip stock. So we have got ASML up this morning, as well as ST Micro and ASM. ASML is up on SK Hynix, buying and choosing its equipment, its next generation equipment, and then the other names there are also being lifted by this sentiment change on technology, this improvement in the sentiment there. So we can see a wall of green across that semiconductor tech sector. Moving on to Puma and Adidas. Puma is down, Adidas is up. We mentioned the downgrade from JP Morgan for Puma and the upgrade for Adidas from Jefferies. So Adidas is quite well run. There's cost controls, there's good portfolio management, and then currency movements could also become a tailwind. That's what analysts are saying, and therefore it is driving the stock there this morning, up 3%. The shares are down for Puma, but not massively, so let's keep an eye on that. And then finally, for insurers, we have got a little bit of weakness in insurers this morning. M&G is down 2.7% on the back of operating profit, missing estimates, and Aegon is also down on the back of selling a stake in ASR Netherlands, as it is kind of moving its focus towards the US. So a little bit of weakness in that insurance sector this morning.
Chloe, thank you. Chloe Melly with a look at some of those stocks on the move. So broadly speaking, a positive session, but not for those insurance-exposed businesses. Coming up on the programme, we'll focus in on one of the stocks that Chloe was talking about, that is Watches of Switzerland. That stock is on the rise after the company's latest trading update. We will speak to the CEO about what is fueling the optimism, particularly around the tariff impact. This is Bloomberg.
Welcome back to the opening trade. We are 18 minutes into the Wednesday session. European stocks are up 0.2%, but we're seeing the damage again in the gilt markets, with the yields up now 3 basis points on the 10-year at 4.83 and the 30-year at 5.73, selling as well across Treasuries, with the 30-year closing in on 5%. Let's get back to the earnings story right now, though, particularly focus on what is happening in the watch space. Watches of Switzerland, that stock jumping in the session, 7.7% on the back of some strong earnings and resilience in the face of tariffs. Let's bring in the CEO, Brian Duffy, right now of Watches of Switzerland. Brian, thanks for standing by with your patience. Talk us through, the expectation that you're not going to see a material impact in the first half of 2026 from tariffs. How is that possible? How has the business navigated this, and how sustained is that picture?
Yeah, well, first of all, we're trading very well, both here in the UK. Our business is 50-50 UK-US, more or less, trading well in the UK, in line with how we come out of last year. Market here's good, initiatives working well. And then the US market's particularly strong. Honestly, it's been strong throughout the calendar year. It's particularly strong and trading well. Again, our initiatives, our investments and so on, all coming through positively across the board. And what's happened with regards to tariffs, I mean, to be clear, we'd all rather that there wasn't a 39% tariff on Switzerland. And the news we have on that, the information we have on it, is that, negotiations continue. George Kern, CEO of Breitling, was interviewed in US TV last week. And he commented that he was confident of a more positive outcome than the 39%, and he hoped for developments in the coming weeks. So I think the general mood in Switzerland is that the situation will improve from what it is today. And in the meantime, what the brands have all done is get as much product into the US, before the tariff change, enabling them to effectively have time and not make decisions that they would then have to reconsider them in the future. So there hasn't really been any impact on conditions or pricing from our brands. We're trading well. We've got less than 8 weeks to go, so we feel very positive about our half year, and clearly that's half of our fiscal year, but that we feel pretty good about. There's uncertainty remains in the second half year, of course. But we think the overall, the other thing to say on tariffs with regards to our business is that half of our business is the clients who are patiently waiting for product, in some cases for years, in many cases for years. And that customer tends to be very unaffected by price increases. Our jewellery business, our jewellery market's very strong, our pre-owned business is very strong. So the actual part of our business that could be impacted by consumer response to higher pricing because of tariffs is relative. I wouldn't say small, but a lot smaller than the market seems to imagine.
Okay. And Brian, we want to get into this. We want to get into the segmentation, but in terms of just going back to Switzerland, and you're seeing some positive signs on that 39%. If we do not get an adjustment on the 39%, does that put the guidance 26 and 28 at risk?
But it's not the tariffs. When we don't pay tariffs, so obviously it's our brand partners that do landing product in the US. Again, something I got to emphasise is that tariffs are on the landed cost, they're not on the retail. So actually expressed as a percentage of retail, it's a fraction of 39%. So even if it were to remain and the impact was all to be in US retail pricing, you're dealing with much less of an impact than people seem to imagine. But we've got to wait and see what the brands would do in the event of a 39% tariff. What we understand is getting looked at is pricing, of course, inevitably, but not pricing exclusively in the US. They would probably spread some of that impact internationally, less of an impact in the US. Will they look at other conditions potentially? But yeah, we've got to wait and see, and there is still some uncertainty until we know the exact outcome of that.
Okay. Brian, good morning. It's Guy. Can I just come back to the inventory question? How much inventory do you currently have in the States, and how long will that inventory last?
We have a normal level of inventory. We haven't done anything, extraordinary. We're not really in a position to either. And again, I just remind a lot of our business, a lot of the brands that we sell, supply comes nowhere near to demand. So the supply schedule's pretty much remained as it is. The brands have brought in product. They have it in their warehouse, not put it into the market.
Sorry. Let me rephrase the question. How much inventory is there in the United States, regardless of whether it's held by you or by the brands, and how long do you expect that to last for? I'm wondering when the price rises, if the status quo is maintained, when those price rises will come through.
I don't 100% know what's been said. George Kern, again, Breitling said he's got 3 months stock. Swatch made a comment saying that they have managed to get even more coverage into the US. Of course, you hear nothing from Rolex or Patek, and we've heard nothing specifically from Richemont. But so it's the brands. I don't know. There was a 45% increase in Swiss watch exports in July, which clearly was brands getting whatever product they could into the US. So they've bought themselves some time. They have good levels of stock. There's nothing, some brands more than others. So they have enough time, and hopefully it's enough time for them to know where the tariff situation lands and take following action.
Brian, sorry to stick with the tariff story, but one more on this. We're trying to work out where in retail chains prices increase, and I appreciate you're saying that the end customer in your sector is pretty insensitive to the price, inelastic to the price. But where do you anticipate that the tariffs hit? Is it all going to be on the end consumer in your sector?
No, again, we'll see that obviously when tariffs come through at first at the 10%, there was some adjustments, including an adjustment to our margins. So the price of the product you're selling went up, but the percentage went down a little with some brands. I think the biggest tool that they have is pricing at the end of the day. But as I said earlier, I think it will be spread across the markets. And relatively, if you look at it historically, I mean, it's not the pricing that would be necessary isn't earth-shattering by any means. There's other things that the brands have to deal into their thinking. There's the price of gold. There's a devaluation of the dollar. So there are a few things that they have been considering in any event from a pricing standpoint. And our category will get more expensive, inevitably. Because of this, but I think a little less than what people are imagining.
Brian, thank you very much. Thanks for joining us. Brian Duffy, the CEO of Watches of Switzerland, and that's not doing okay. What's not doing okay right now? Bond markets and some FX against the dollar. So the pound, the pound and the yen in particular are in focus. We see quite a lot of action in bond markets, more than maybe just an hour ago. European bond markets seem to be trying to break away from that higher yield trend we've seen in the past 24 hours. But maybe the Treasury and UK gilt markets won't let them. So we'll focus in on what's going on in bonds, the read across into stocks. That conversation coming up next. We'll be joined by George Saravelos, the global head of FX research at Deutsche Bank, with plenty to say on current developments in these markets. This is Bloomberg.
This is the opening trade. We are 30 minutes into today's session, and the futures are pointed to a slightly more bullish picture, but that's not what you're getting right now. This looks like an unconvincing gain coming through across the benchmark of just 0.1%. There are some individual names, of course, in the mix, but the concerns around the fact that we have not put the bond sell-off to bed seem to be a headwind to equities. You do see some gains coming through for the DAX, up 0.3%. Again, this is in the context that European stocks sold off 1.5% yesterday. Adidas is part of the mix there. You're seeing some of the tech names, particularly in France and in the Netherlands, performing better on the upside coming through from tech overall. The CAC current up 0.4%. Here in the UK, though, the FTSE 100 is currently flat, just down 1 point. And again, we're seeing that sell-off in the gilt markets and pressure on the pound. Guy?
The internals are really unconvincing, I have to say, really unconvincing. Take a look at what is happening here. Higher, 317, lower, 259. Basically fairly well balanced, a little bit to the upside, but not by much. Average volume, yeah, we are definitely down on that. So actually this feels like an unconvincing story as well from that perspective. We need to get everybody back. We need to get everything going to get a really true picture of what is happening here. Got some 52-week highs and 52-week lows that are definitely worth sharing with you. The housing sector in the UK remains under significant pressure. Here's Barratt Redrow, down by 33% on the year, hitting another 52-week low today. We're trading at 348 on that stock. Let's take you to the gold miners. We were talking to Evie Hambro a little bit later on, earlier in the programme about this, talking about these kinds of names. Look at Fresnillo, up 281%, continuing to climb as that gold trade continues to deliver. The only fly in the ointment, you could argue from his perspective, is that actually what we want to see is dividends, not buybacks. But that's maybe a story for further down the road, Anna.
Yeah, absolutely. Let's get an update on some of the other things we need to know this morning. We start with global geopolitics. Chinese President Xi Jinping has appeared alongside Russia's Vladimir Putin and North Korea's Kim Jong-un at a military parade marking 80 years since the end of World War II. President Trump took aim at the Chinese leader, accusing Xi of conspiring against the US with Putin and Kim. President Trump making those comments on social media. Treasury Secretary Scott Bessent is reportedly planning to start interviews for a successor to Jerome Powell as soon as Friday. According to the Wall Street Journal report, there are 11 contenders, including Fed Governors Chris Waller and Michelle Bowman. Following the interviews, Bessent plans to recommend a final list of candidates to President Trump. And global bonds are once again facing renewed selling pressure as jitters around inflation, debt sales and fiscal discipline erode sentiment towards what had previously been some of the world's safest assets. So once again, our eyes are turned, Tom, not really by what's happening in stock markets this morning, but by what's going on in global bond markets. Those yields in Europe took a little while to get going. Gilt markets opened up and then yields started to tick higher.
To your point, if you carve out the UK, European yields, European bonds, a separate story, because the focus is really what's happening in the Treasury markets and gilts. Once again, the 30-year is within sniffing distance when it comes to US Treasuries of that 5% mark. The last time we got that was in May. So we're watching that level right now, 499 on the US 30-year. Here in the UK, the gilt's selling off again. And to your point, Guy, the fire continues to be under the feet of the UK Chancellor Rachel Reeves, with the 10-year at 484 and the 30-year yields up 5 basis points.
She's having another tough morning, isn't she? She's definitely having another tough morning. Why do I care about the 30-year? I thought it was really interesting, the conversation we had earlier with Eric Londgren.
Yeah.
Why does the UK care about the 30-year? We don't fix mortgages to it like the United States does. We don't have to issue asset. If the Bank of England stops selling some of it, maybe actually the pressure would ease off a little bit. But the UK 10-year is at 4.8. I was talking to an investor yesterday who thinks we could go sharply higher from that. Eric was unconvinced by that. He thinks the tops are in. When the BBC starts talking about the bond market, you know, maybe that's maybe the top in the market. We just need a kind of front cover of The Economist, and I think we'll probably be there. But the story this morning is that this is a market that still is having a difficult time of things. George Saravelos is the global head of FX strategy at Deutsche Bank. Good morning. Do I keep selling the pound if the bond market keeps selling off? Is that the trade?
I think so. You're seeing a negative relationship between the currency and yields, which is quite similar to what we saw with the dollar if you think back to April. And this is all about a repricing of fiscal risk premium. Yields are not going up for good reasons. The market is concerned about fiscal policy. And if you look globally, there's a bit of a perfect storm. The story in the US is about the negative supply shock on the back of the restrictions to immigration, obviously the compromise to Fed independence. And it's ironic these sell-offs are happening as we're debating Fed cuts. And in the rest of the world, you're seeing either an easing of fiscal policy, for example, in Germany, or huge issues around tightening, for example, in France and the UK. So it's all combining to raise yields. It's for bad reasons, and I think it makes sense that the pound is selling off on the back of it.
Just how useful, what is the comparison between what is happening in the UK and what is happening in the United States? Is what is happening, the pain we're seeing in the UK, going to be represented writ large in the United States? How useful a comparison is it?
I think that's a great question, and I think it's a very useful comparison because those two economies have one similarity, which is external deficits. And when we look at the bond market, we've been writing about this for a long while. Many people focus on debt to GDP, on fiscal metrics for vulnerability. What we look at is external deficits, because the external deficit and the net international investment position tells you how reliant a country is on foreign investors. And foreign investors set the marginal price of debt. The common thing both the US and UK have is they rely on those foreign investors. There's a reason we don't care about what's going on when there's government instability in the Netherlands, for example. It's got a very large surplus. So that's the commonality. And in terms of the regions we're concerned for instability, it is the US, despite the dollar rallying over the last few days, the UK, and, for example, other places such as New Zealand.
So the US and UK united by that theme then, George. What is the epicenter for you of this drama we're seeing playing out in bond markets? There are plenty of local expressions of it. But is it all about Japan? Is it all about concerns around Fed independence? Where do you pin the blame, if that is the right word?
Well, I think it adds up. It is a global phenomenon. And if you look at the long end of curves and term premium, that's globally determined. We have an international capital market. But if I look at the epicenter of the stress, as you mentioned, it most definitely is the US as the largest marginal supplier of debt. It is the UK having these big external vulnerabilities. To some extent, it's France, but I think France is protected within the European construct. And Japan's the really interesting one, because we're seeing these sell-offs, even though Japan is a huge saving nation. And I think what's key there is the Bank of Japan. The Bank of Japan refusing to hike rates, a sniff of fiscal dominance, if you will. But I think, for example, if we were to see the Bank of Japan hiking rates, you would see the long end of the JGB curve behave much better, which, by the way, has a similar extension to the US debate. The more aggressive the Fed cuts, ironically, I think you could be looking at a more disorderly back end of the bond market.
Yes, well, I suppose, yes, that's interesting, George. And I want to get further into your views on whether you see the market being concerned right now about Fed independence. Are the levels of cuts being priced in the United States, are they justified by the data, or do they reflect a lack of independence at the Fed?
So I would say at the moment it's more the former. If you look at what the market's pricing, what it's done is it's brought forward these rate cuts. But if you plug in, for example, the Fed SEP forecasts into things such as a Taylor rule or other balanced rules which the Fed is using, it's not that out of line. I would say the quintessential measure of central bank independence is long-end inflation expectations and break-evens. And up until the last few days, those were very subdued in the US, but they are starting to pick up. And I worry a lot more that the market could start pricing a bigger loss of Fed independence, which again would imply higher break-evens. It's all about the mix of data. The worst possible scenario is if the Fed enters an easing cycle as the US inflation numbers start to pick up a bit more. And I think that really is a big risk. And the Fed, to some extent, has created a very challenging backdrop by locking itself into these rate cuts for the rest of the year.
George, would you characterise, good morning, would you characterise a September cut, a cut this month from the Fed on the 17th, therefore as a political cut, as one of our guests this week did?
Well, I think it's been much easier for Powell to obviously talk about a cut because you had payrolls weakness. But there's no doubt, and if you look at the composition of the board, we have the Stephen Miran confirmation hearing coming up on Thursday. The board could very easily see 2, 3, 4 dissents, depending on how things shape up with Liza Cook as well, towards cuts. So I think the pressure is undoubtedly having some effect. You can even see it in market pricing, where after Powell's departure in Q2 of next year, you're seeing, again, some acceleration of rate cuts. So yes, I would most definitely say the politics have entered into the Fed reaction function.
How do we think about the dollar then? I mean, much unloved, of course, year to date. And yet in the last few days, given the ruptures in the bond markets, we've seen moves into the dollar, George. What are the competing pressures on the greenback in the weeks and months ahead, given the ruptures in the bond markets and question marks about Fed independence?
I think you've seen this return of the traditional correlation between risk aversion and the dollar over the last few days. But I don't believe in its sustainability. As we discussed before, if I'm looking at the key sources of vulnerability, UK and the US really are at the epicenter. as deficit nations when you get these fixed income sell-offs. What's interesting is if you look at the last few months, April, May, you had a buyer's strike with US assets. The buyers started coming back over June, July. But what's most interesting is they came back into the US equity market rather than to the bond market. So there is there an unwillingness to finance the fixed income side of things. And if that gets disorderly, you start seeing an unwind of some of the froth in the equity market. The funding of the US external deficit will be severely challenged. So I'm not really convinced by the dollar rally we've seen over the last few days. And I would look at the US as being on the vulnerable side of things, given the global backdrop.
George, what's the right price for the dollar for the rest of the world to fund its deficits? What's the right price for debt in the United States for the rest of the world to fund its deficits?
So it does depend on the currency. For example, if I look at our global suite of valuation metrics, the CNY stands out as being extremely cheap. And that's reflected in the ongoing massive widening in the external surplus of China. So there, I think you could easily see a 10, 15% move if we're thinking about valuations. And that wouldn't really put a huge dent to just how cheap the CNY is. If I look at the broad dollar, just to get to somewhere closer to fair value would be another 10% move. But then the question of financing of those external deficits becomes a bit of a difficult one. How much do dollar assets need to weaken? If you think that all the adjustment has to happen via FX rather than anything else, it could be on some of our models as much as a 20 to 30% decline in the dollar.
George, you say you're unconvinced by the dollar rally. We see weakness, though, in the pound. We've talked about in the yen this morning. What are your thoughts on the yen right now? A lot of focus on when we're going to get a hike, if we get a hike from the BOJ coming through.
Well, again, Japan is a super fascinating place these days. And this question of a rate hike, even, of course, the Bank of Japan frames it as a debate on underlying inflation. It's a deeply political one. It's the political economy of Japan at the moment that I think will drive the outlook. And if you think back to 10 years ago with Abenomics, there was a big shift towards supporting inflation and easy central bank policy. What we believe we're seeing at the moment is a shift in the underlying political economy of Japan against inflation. Inflation has become too painful. It's resulting in these LDP losses. On Monday, we're seeing the debate around the resignation of Ishiba. So we think we're transitioning into a scenario where the political economy will turn a lot more supportive to Bank of Japan rate hikes. I think that is what is needed, actually, to stabilize the long end. One surprising thing this year is that foreign buyers are huge into the long end of the JGB market, and they're losing money. What's missing is the domestic buyers, which are still reluctant. And I think one reason they are is because the BOJ is behind the curve. So again, if the Bank of Japan hikes, I think that will also help, ironically, the fiscal picture in Japan, and will most definitely help the yen.
George, I want to get your views on the euro, the strength of the euro, of course, what that's meant for the inflationary dynamics. The markets are not pricing in any additional cut from the ECB between now and about July, well, very little, 15 basis points, so not a full cut. What's the trajectory for euro, given your expectation that this upside for the dollar is going to be short-lived?
So one observation to make on the euro is the economy has been incredibly resilient. If you think about the fact that we've got 15% tariffs, but the manufacturing PMI is up at a 2 to 3 year high, there is an underlying resilience there that I think is buttressed by the strength of the private sector balance sheet, especially for corporates, which is probably at its strongest over the last 3 decades. On top of that, you have the fiscal policy support out of Germany. So I think the combination of those two should support a move in the euro above 120. So that's the forecast we have. We have the euro going to the upper 120s over the next couple of years. One last thing to mention, Guy was mentioning before, should we care about the long end of the curve? The European economy is sensitive to the front end. If ECB front end rates are low, that's very good for the European economy. The US economy, in contrast, is very sensitive to the back end. So if we're thinking about this global bond sell-off, where is the biggest macroeconomic impact? It is much larger in the US in terms of leading to a tightening policy compared to Europe.
George, thank you very much. Thanks for joining us. George Saravelos, Global Head of FX Strategy at Deutsche Bank. Coming up on the programme, it's all about bonds this morning. We continue to see that sell-off, the yields going higher here in Europe. We'll get some further views. We'll dig into the details in a little more, with a bit more context shortly. This is Bloomberg.
We're in the realms of a local high in yields. I'm not going to pinpoint it and say it's today. I would have a reasonably high degree of confidence if you could fast forward 3 or 6 months. You'll probably make a lot of money in these bond markets.
A lot of money?
Yeah. Bear in mind, a 30-year yield, if you get a rally of 100 basis points, say, you're talking about, 20% capital return. So could you rally 25 basis points? You could rally 25 basis points in very, very little.
That was Eric Lonergan speaking to us earlier, discretionary macro head at Calibrate Partners, on this very programme. Let's talk about the markets in 3 minutes. And, of course, we'll focus in on the bond market action, the impact it's having on other assets, perhaps. Mark Cudmore, our Markets Live executive editor, joins us now. Eric there, dangling the prospect that we can draw a line in the sand, that we can turn the page and stop having these days where we're obsessed with yields going higher in global bond markets. That's not today, but are you convinced by some of the arguments he's making, Mark?
I thought the interview with Eric was absolutely excellent. He makes a really strong case, very compelling. I think he's slightly early. I think there's a couple of things here to acknowledge. First of all, the fundamental concerns about bond markets shouldn't play out in the space of a few days. These are really long-term drivers. We're suddenly panicking. Now, the flip side of that is these are internal drivers, driving this move. It's internal catalysts. It wasn't suddenly a data print that got us scared yesterday. It was we've just suddenly got, triggered some losses. We've broken through levels that's forced some more selling. That's the kind of move that either burns itself out and reverses rapidly, or it suddenly starts spiraling and we need to get some kind of reaction. At the moment, I'm not sure which way we'd go. I'd veer toward Eric's camp, that we're probably near a local high, but I say it much more nervously than him. In the same way that he said we could get a 25 basis point move lower very quickly, we can get another 25 basis points higher very quickly. We've already seen UK yields do 5 basis points today at the long end, 7 basis points in 30 years. These are massive moves for long end bonds. So at the moment, the market's on the back foot. He is right that it shouldn't all play out in a short space of time. I slightly defer with him in the 3 to 6 month view, in terms that I think that overall over the coming months we still have more long end bond weakness to come, but I don't expect it to play out over the next couple of weeks immediately.
Mark, one of the points that I thought that he made that was excellent, which was basically, why do I care about the UK 30-year? Honestly, why is it so important? You don't have a mortgage market that's tied to it. The government doesn't have to issue it. You're in a situation where it really doesn't matter. Why are we so focused on the UK 30-year?
He's absolutely right. I think there's only small sectors that really care, but the point is there are sectors that do matter for everyone in the UK. I mean, things like pension funds own a lot, that the 30-year paper that's out there. And he's right. Probably bonds around the world will kind of go, stop them. Governments around the world will stop issuing so long out the curve. And many pension funds might change their mandate to kind of go, why are we buying all this long-term stuff? We've lost so much money. But the fact is, they own it right now and they have lost money. So it is consequential for the people who own it. It's consequential for banks out there. It's consequential for pension funds. Longer term, macroeconomic-wise, sure, it's an irrelevance. They don't need to issue there. It doesn't have the impact in the economy as it, say, does in the US, like your last guest, George Saravelos, just said.
Oh, we're talking of George Saravelos, Mark. He made the point that he doesn't think France is going to be central to the bond route because of the structures of the EU essentially protecting France. And we're seeing Oates relatively well behaved to the sovereign debt of France today. You disagree with that? You think France could become the epicenter?
Yeah, I think that France will be the epicenter over the next month. I actually think it's the one where I'd be most comfortable kind of getting long the dip in terms of, if you want to play the Eric Lonergan's view, as I said, it's because that EU backstop. I think the EU overall as a whole doesn't have a worry, and EU will step in panic situations. But the catalyst in the domestic politics side in France, they're just mounting up in the coming weeks. So I think for the next few weeks, France is the focus of pain, but maybe it's better longer term.
Bloomberg Markets Live executive editor Mark Cudmore. Remember, of course, you can get up-to-date analysis and insight from Mark and the rest of the team. Just go to MLIV Go on your terminal right now, and you can see his thinking around France and the sovereign debt challenges there in his most recent post. Now, here's what else to think about today. 2:15 p.m. UK time. Andrew Bailey, the governor, of course, of the Bank of England, will appear in Parliament on a day again when we're seeing that rout in UK gilts. At 3 p.m, it's the jobs data in terms of job openings out of the US. We'll break that for you. 4 p.m. UK time. President Trump welcoming his Polish counterpart as well. So we'll see what comes out of that meeting. Anything on Ukraine, of course, will be interesting. So that is what is on the agenda. Keir Starmer as well, meeting his Spanish counterpart, Pedro Sanchez. Both of those countries facing their own idiosyncratic budget challenges, where we hear that Chancellor Rachel Reeves will be announcing the date of that October budget. November.
That's going to be a big focus, isn't it, for markets? I'm interested in some of the UK things. Let's pick out some of the highlights of the day ahead with Valerie Teitel, who joins us. I'm interested in the UK stuff. Bailey's going to be speaking on a day where gilt yield's still in focus. But I know we've got Jolts, so we should probably give a nod to that particular bit of data out the United States. Labour market front and centre this week.
Yeah, exactly. We do have a lot of labour market data. It starts off with the Jolts. Today we have ADP on Thursday and then the big non-farm payroll report on Friday. Remember, the Jolts report is slightly backward looking. It's the previous month's data versus what the NFP does survey. And sometimes it does, or I guess markets do tend to jump to conclusions because it's the first one this week.
It's very revised, doesn't it?
It does. But look, the market has been very sensitive to labor market data, and we've been talking about this global bond route. You know, if we are going to continue to see curves steepen, pricing in more cuts into the front end could be another way we could do that. So if we get another round of weak labor market data, maybe the market is comfortable pricing in 3 full cuts for the remainder of the year. So more additional cuts after September being more of a done deal. That could be something that could tempt these curves steeper. Remember, 230s in the U.S., that yield curve is already trading at cycle highs around 130 basis points. So we are very stretched, but that could be something that could cause a breakout in the curve.
Let's talk about symmetry. Do we get a bigger reaction with weaker jobs data or a bigger reaction with strong jobs data?
Yeah, that's a good question. I think the market is more likely to focus on weaker data than stronger data. Stronger data, they could just shrug off in some way because Powell's already kind of conceded that the labor market has weakened. We know that there's other camps at the Fed, such as Christopher Waller, who have been saying that the labor market is flashing red. So they might look through stronger data and just harp on the revisions and the lower than expected print that we got in NFP last month. But that's a very good question. We come out with a massive payroll beat on Friday. Does that September Fed cut get priced out? I don't think so, given what Jackson Hole, given what we learned at Jackson Hole.
The market reaction to the prior miss on non-farm payrolls was pretty pronounced,
yes,
wasn't it, in terms of pricing in those additional cuts, and then we got the revisions. Talking of the revisions, do we trust the data? I mean, this is a stats bureau that's seen its head change, political pressure coming through there as well.
Look, it's the best data we have is really the best answer. Yeah. It's still the best data we have, the best pulse of the labor market. Yes, it does get revised, but it's the best we got.
Yeah, we have those issues, don't we, with data around the world, certainly here in the UK. Valerie Teitel, thank you very much. Bloomberg's Valerie Teitel, of course, on the bond markets. And once again, the bond markets find themselves at the epicentre of our focus this morning.
I thought today was going to be different. It's not. Bond market still in focus. Rachel Reeves still
we have to wait almost 3 months. November the 26th is going to be the date, according to Bloomberg reporting.
3 months now. 3 months of this conversation, pre-budget.
Get on with it. Anyway, talking of getting on with it, that wraps things up for us. The Pulse is up next. Hope you enjoyed the show. This is Bloomberg.